this is Rachel Marshall. Today I want to talk with you about why cash value of life insurance is a superior and often uncovered valuable asset that you want to have in your financial portfolio. So first of all, cash value of life insurance. This is different than the typical way most people think about life insurance. Most people think of insurance as insuring against a loss and therefore providing a benefit if some bad event happens. Life insurance being paying out a death benefit if somebody passes away. And certainly all life insurance does have a death benefit. But primarily, when we're looking at life insurance as an asset to hold on your balance sheet and a place to store cash, we're really valuing the cash value portion of life insurance. So why is cash value valuable to you, possibly even over a bank account in storing your money? Well, first of all, when you put money into a life insurance policy, especially designed whole life insurance policy, your money grows inside the policy through dividends and interest. Both of those pieces of growth contribute to the cash value. Whatever the cash value amount is at a given time will never dip below that value again. It will always continue to grow. Now, this is independent of whether you funded the policy for your whole life or whether you elect an option called reduce paying up, which means you stop paying the policy at some point and have no more premiums due. The cash value, once the floor is set, you'll never drop below that cash value amount. So how does cash value grow in your life insurance policy? Your premium is the dollars that you pay to the life insurance company to keep the policy in force. Think of this as putting a deposit into your savings account on a regular basis. The life insurance company then is investing those dollars. And what they're doing is they're holding various assets on their books in the effort to grow their money. Now, life insurance companies, different from banks, view a very long-term financial strategy approach, whereas a bank is using leverage and fractional reserve banking. A life insurance company is holding dollar for dollar reserves, meaning that you have a lot more stability with the life insurance company. I would like to also note that at a life insurance company, most of the holdings that they have are corporate grade bonds that are held through a full duration, and they have something called laddering. So they have various time frames that those bonds expire. And again, they're always looking for this long-term approach. In fact, life insurance companies are so stable that banks themselves invest tier 1 capital assets into something called bank-owned life insurance, very similar to specially designed life insurance, but specifically, this is held by the bank as an asset on the bank's balance sheet. It's a place where the bank puts some of their money that they want to have as reserves and equity and very safe money. And they're able to use that to offset employee benefit programs, things like 401ks and healthcare plans. And so this money, as it's growing in their life insurance cash value, is able to provide an income stream that helps offset higher costs for the bank. Another reason why life insurance is valuable is that this is one of the premium asset classes that is not taxed. So when you have money growing inside of your policy, that growth is not taxed. You also have the death benefit payout to the beneficiaries, tax-free. So in two ways, this is non-taxed. I want to compare this over to a typical asset that you may think of, say growing money in a stock account or in a savings account or in a money market. All of those accounts will be taxed. So that means that when you grow your money, the interest is taxed. You pay tax on the interest. Now, when you're growing in a life insurance policy, you're not paying tax on that growth. So as you have dividends paid into your policy, as you have interest growing inside the policy, you are not taxed on that growth. You also are not taxed when the policy pays out the death benefit. Because we're avoiding tax, we have a differential in comparing interest rates that you could get in other places. So for instance, with a life insurance policy, if we look over about 30 plus years, you're going to see a cash value growth that will be in the ballpark between 3 and 5%, between 150 to 300 basis points above what you would be getting in a typical savings vehicle. Now, when we compare across that the life insurance cash value growth is tax-free, whereas the typical growth that you're getting in a bank is taxed, the taxable equivalent of your cash value life insurance growth is closer to 4 to 6%. So that's giving you a huge advantage in terms of growth. That's also tax-free growth. It also is a guaranteed, consistent increase. So instead of having rises and falls like you do in the stock market or in equities or indexed funds, you're in a position where your growth is consistent and you have no potential for loss. So if we were comparing another asset to what life insurance would perform at, we would need to see a consistent year in and year out growth rate that is about 5% in order to be equivalent to that comparison, what life insurance can perform at for you over a long span of time. So this allows you to keep pace at least with inflation. So as you have rising costs in your personal life or in your business, you are able to combat that with a growth rate that's consistent and guaranteed. This is one of the reasons why life insurance stands out as an alternative asset class, a place to store your cash where you have considerable growth, tax advantages, combating inflation, and guarantees. Thank you so much, and I'll see you next time. Hi, this is Rachel. I hope you enjoyed this episode of Money Secrets. If you did, like this video, subscribe to our channel, and leave a comment below. I would like to invite you to get your free cash flow generator to help you start keeping more of your money. Come on over to marshallsinsurance.com/cashflow generator to sign up.